Alright, MegaWell team, welcome to the second episode of Learn to Trade. Today we're going to be taking a look at the Ichimoku Cloud Technical Indicator. Now the Ichimoku Cloud Technical Indicator is quite a complicated one. At least it looks very complicated. There's a lot of stuff going on the chart. But once we break it down, it's going to be a little bit more simple to wrap your head around, and I would be bold to assume that it's going to probably become one of your most favorite and most used indicators to determine overall market direction and trend. So first and foremost, what is Ichimoku Cloud? So the Ichimoku Cloud is a collection of technical indicators that show support and resistance levels, as well as momentum and trend direction. So it does this by taking multiple different moving averages and basically plotting them along the chart. So before we get into it, we're just going to run through a different couple names. So we've got our green cloud, we've got our red cloud, we have our lagging span, which is the black line, we have our conversion line, which is the blue line, and finally we have our baseline, which is the red line. To start with today, we're going to get rid of the lagging span, the baseline, and the conversion line, and we're just going to talk about the two separate red and green clouds. We'll add the rest of the indicators in later, but we're just going to start with these two. So there are two general rules. The first general rule is when the price is above the clouds, we're in an uptrend, and when the price is below the clouds, we are in a downtrend. Simple as that. So if we had to trade based on these two ideologies alone, we consider these three separate rules. Rule number one is only enter the market when the price is above the clouds. Look to sell or short when the price is below the clouds, and never enter when the price is in between the clouds. This is because according to the clouds, the direction is unclear. So really simple, guys. Really simple when we break it down like that. Let's add some stuff to the chart. Let's add our lagging span. So it's going to get a little bit more complicated here, but the lagging span is essentially the current closing price of the market shifted back 26 periods. So what does that mean? So on a 1 day chart, a 1 period is 1 day. 10 periods is 10 days, 26 periods is 26 days. So no matter what chart you're looking at, no matter which time frame, the lagging span is always going to be 26 periods behind the current closing price. To make it more understandable, if we move this lagging span forward 26 days, it would be basically representing the current market price action. All right? So how do we use the lagging span to determine the trend? So there are two ways we can do so. For confirmation of an uptrend, we're looking for both the lagging span and the price to be above the clouds. When we see the lagging span and the price are both above the clouds, this is confirmation of an uptrend. Vice versa, when we see the lagging span and the price below the clouds, this is confirmation of a downtrend. So really simple stuff there, guys. Really simple stuff. All right, let's move on to the next one. So now we're gonna add, let's delete these little circles. We're gonna add our conversion line. We're gonna add our baseline. We're just gonna get rid of everything. We'll get rid of the lagging span. All right, we'll add our conversion line, baseline, and get rid of our lagging span. So the conversion line is also known as the trigger line. All right. So we've got our conversion line or trigger line and baseline. So they're essentially the same lines, but they're calculated a little bit differently. So we'll start with our blue line, the conversion line. So the conversion line is derived by finding the midpoint of the highest and lowest low over the last 9 periods. All right. So the midpoint of the highest and lowest low over the last 9 periods. So remember, these are moving averages. So moving average over the last 9 periods of the highest high and lowest low. The baseline, so the red line, is derived by finding the midpoint of the highest high and lowest low over the last 26 periods. So remember, a period is equal to the time of the chart you're looking at, the time frame. So if you're looking on a 1 hour chart, 1 period is 1 hour. If you're looking on a 7-day chart, 1 period is 7 days. All right, just to clarify that. So we use these lines to determine entry and exit points. So remember, we use the clouds to determine the trend, we use the lagging span for confirmation of the trend, and we use the conversion line and baseline for entry and exit points. So we use them in crossovers. So every time they cross over, they tell us a bit of data, give us a bit of data. So for our bullish entries, so for our uptrend, when we're looking at any uptrend, we can determine our exit point when the conversion line drops below the baseline, and we can determine our entry point when the conversion line goes above the baseline. We have here and here as well. All right, so exit, conversion line drops below baseline. Entry, conversion line crosses above baseline. All right, and if you're looking to short or you're in a downtrend, you can use the same concepts. All right, when the baseline crosses above the conversion line, it could be an entry point if you're looking to short, and vice versa. If the conversion line crosses above the baseline, it could be an exit signal if you're looking to short. So that is how you use the conversion line and baseline. So let's put it all together. Let's put all the elements together. We'll add the lagging span back in. We'll delete all those. So we're talking bullish setups and long entry points. So how would we take that information and apply it to a long signal or entry signal for a bullish continuation? So number one, first we need to establish an uptrend. So we establish the uptrend by 2 things. Number one, the price is above the clouds. And number 2, we've confirmed the continuation of the trend by confirming the lagging span and the price is above the clouds. So our entry signal may be considered when the trigger line, so the conversion line, crosses above the baseline, and our exit signal is considered when the trigger line is crossed below the baseline. So for our bearish setups or our shorts, we're looking at the opposite thing. We're establishing a downtrend first, where the price is trading below the clouds, and we're looking for confirmation of that with the lagging span and price below the clouds. Our entry signal will be considered when the trigger line, so conversion line, crosses below the baseline. Our exit signal is considered when the trigger line, conversion line, crosses above the baseline. So guys, that is how you use the Ichimoku Cloud. I thought I might do a quick video on it since I do mention it a lot in my videos, and it is probably one of my favorite technical indicators to use on all time frames. I hope this makes some sense. I hope you now understand it better and are able to apply it in your own technical analysis. If you do have any questions, remember to comment below. Remember to like and subscribe for more amazing content. We've got a couple more of these videos coming. We're planning to do a Let's Learn How to Trade or Learn How to Trade series video for basically every technical indicator, or at least the most commonly used technical indicators, as well as all market trends, and we'll do candlestick patterns as well. Remember to like, comment, and subscribe, follow us on Twitter, and join the Telegram discussion in the link below. I'll catch you in the next videos.